This chart shows a terrifying red nosedive that suddenly skyrockets into the green. But what you can't see on this screen is the catastrophic investing mistake 99% of people are making right now, completely without realizing it. This diagram illustrates the 12 common investor profiles. The trap is that almost everyone mistakenly locks themselves into just one of these rigid identities, whether they realize it or not. Relying on a single profile acts as an artificial ceiling. By chaining your money to one specific set of rules, you severely limit your upside and lock yourself out of massive wealth-building opportunities. We're going to break down the exact strategy that bypasses this limitation. Hit subscribe right now to learn the blueprint. Recognizing this single identity loop is the absolute prerequisite for adopting the multi-layered strategy used by the top 1%. Let's look at the options. First, you have the conservative investor. They park their cash in fixed deposits and government bonds, vehicles designed for maximum safety and stability, which guarantees an extremely low return. On the exact opposite end is the aggressive investor. They dive into highly volatile assets, willingly risking total financial wipeout just for the chance at massive, explosive upside. This graphic shows how moderate and growth investors attempt to bridge the gap. Moderate investors try to balance immediate safety with future potential, while growth investors target companies they believe will rapidly expand in the coming years. Then there is the value investor. They scour the market for highly underpriced assets, buy them cheap, and rely on extreme patience, waiting years for the market to correct the discount. Rather than waiting for a distant payday, the income investor prioritizes the present. They construct portfolios focused entirely on generating immediate, recurring, and predictable cash flow through dividends. Safety sacrifices growth, and pure growth destroys your safety net. Most people pick one and accept the trade-off. The long-term investor takes a hands-off approach, building massive wealth by simply letting time slowly compound their assets over decades. Compare that to the short-term active trader, who willingly sacrifices their mental peace, glued to screens to chase immediate, stressful market fluctuations. Similarly, the passive investor delegates the heavy lifting entirely. By relying on broad index funds, which track entire sections of the market automatically, they minimize their daily oversight. This is a stark contrast to active investing, a strategy requiring constant daily portfolio adjustments in an attempt to outperform average market returns. Moving away from the stock market, real estate investing offers a highly tangible physical method of generating recurring income and appreciating wealth. That physical tangibility is the exact opposite of angel investing, where capital is deployed into highly conceptual, unproven startup companies for a high-risk gamble. Focusing exclusively on one dimension, whether it's timing, effort, or asset type, leaves a portfolio exposed to specific preventable risks. The top 1% don't pick a side. They build a multi-layered architecture, using passive stability to fund aggressive growth. By combining long-term holding with compounding, you generate exponential results. An initial investment of 1 lakh rupees seamlessly transforms into 15 lakh rupees. It is time to abandon blind guesswork and start applying this combined exponential growth strategy to your own capital immediately. Subscribe to the channel right now so you don't miss out on our upcoming breakdowns of advanced high-leverage investing strategies. Building real wealth requires moving past the limits of a single archetype and mastering the combination of these specialized approaches. Please note, I am not a SEBI-registered advisor. This video is for educational purposes only. Please do your own research before making any